Good day subscribers and welcome to Momentum channel. In this video, we'll first review the companies that are in the Dow Jones Index, select quality dividend paying stocks based on the criteria that we've set, and then analyze those shortlisted stocks. Of course, at the end, you will decide which one of these stocks are better buy at this time. Before we proceed any further, for those of you who may not be familiar, the Dow Jones is a stock market index that measures the stock performance of 30 large companies that are listed on the stock exchange in the United States. Alright, so here's the list of the 30 companies that are in the Dow Jones Index and their year-to-date performance. On top of this list is Microsoft, which has had the best performance year-to-date in the Dow Jones Index. The performance of Microsoft has been 16.23%. Following Microsoft, we have Home Depot with a performance of 9.66%, and we have Walmart on the third spot with 5.82% performance. As you could see, majority of the companies that are on our Dow Jones 30 list of companies are actually in the red, in a sense that their performance year to date has been negative. The worst performer of the Dow is Boeing with a negative performance of 63.17%, followed by Raytheon Technologies Corporation with a negative 40.53% and ExxonMobil with 39.83% performance. Alright, so in order for us to be able to analyze the stocks in the Dow Jones, we wanted to first apply a couple of criteria so we have a shortlisted number of companies that we can dive deeper into. We start off with our Dow Jones companies list, then we want to make sure that the companies are actually currently paying a dividend. The next criteria was that the dividend yield should have been more than 2.5%. So that's a criteria that we defined. And the last criteria we looked at was ensuring that the company has a dividend payout ratio of under 50%. Now, this is a little bit more conservative, but allows us to select the more quality stocks on our list. That left us with 5 dividend paying stocks on the Dow Jones to dive into. Here's an overview of how these companies stacked up when we applied these measures. As you could notice, we have listed the forward dividend yield as well as the payout ratio for these companies, and as an additional source of information for you in case that interests you, we've also listed the years in dividend growth. So this shows that the companies have had a streak in terms of their continuously growing their dividend for how many years. For instance, here we have Procter & Gamble that has increased their dividend for 63 straight years, or 3M that has done so for the past 61 years, and Coca-Cola and Johnson & Johnson, which both have increased their dividend continuously for the past 57 years. The companies that are highlighted in green are the ones that meet all of our criteria. There you have it, the list of 5 dividend companies in the Dow Jones that meet all our criteria: Cisco, Merck, Goldman Sachs, Travelers Companies, and Walgreen. Next, we'll proceed to analyze these companies and their stocks according to a number of metrics that we've defined here. First and foremost, we want to look at their revenue growth. We want to also take a look at their net income growth. We'll also look at their total assets and total liabilities, and of course, look at their valuation. Given that these companies belong to different sectors, it would be hard for us to really compare them against each other. That's why we rather have them compared versus their median in their sector, their respective sectors, and then decide for each of the companies by itself whether we think that that's a good buy or not. Looking at the income statement for Cisco Systems, you'd notice that both in terms of their revenue growth and their net income growth, there have been some inconsistencies, particularly for the net income growth. As you can see, the trailing 12 months is currently in negative and showing a negative of 18.41%. Definitely not something that you would hope to see for a company. As we know, of course, the time is tough right now with the economy being impacted due to the pandemic. That being said, you would hope that both in terms of the net income or revenue growth, they were doing a little better. They're not doing as poorly for revenue growth, but the net income definitely has been hugely impacted. Now, looking at their balance sheet, things are a lot more positive. Of course, their total assets exceed their total liabilities, and so does their current assets versus their current liabilities. It tells you that in the short term, the company has enough liquidity to overcome any challenges and any short-term costs. As for the valuation, overall, Cisco stock is doing better than the sector median, both in terms of their price to earning ratio and their price to cash flow ratio. However, for their price to book value ratio, they are doing poorer than the sector median. Moving on and looking at Merck, which is an American multinational pharmaceutical company, they are doing a lot better in terms of their revenue growth. In fact, across the board, you see constant positives year over year, and their trailing 12 months is also doing better. As for the net income growth, they had a little bit of hiccup back in 2016 and 17, but since then they've recovered, and in fact, they have a positive trailing 12 months net income growth of 20.81%. Their total assets and liabilities, as well as their current assets and liabilities, is also doing okay. In fact, when I look at the balance sheet, I would like to see for the company that their total assets exceeds their total liabilities. Similarly, I would like to see that their current assets is larger than their current liabilities, which in fact is the case for Merck. Now, looking at the valuation for this company, similar to Cisco, they are doing better than the sector median for PE and the price to cash flow, but in terms of their price to book ratio, they are doing poorer than the sector median. Goldman Sachs is the next company on our list, which is a financial institution. Looking at their income statement, particularly the net income growth, is somewhere that we see a couple of negatives for December 2019 and for their trailing 12 months. Also, their revenue growth appears to have been suffered recently due to the economic downturn. Looking at their balance sheet, their total assets well exceeds their total liabilities, which is a positive sign. But as for the valuation, across the board, they appear to have been priced larger than the sector median. So something to be mindful of. Next, we have Travelers Companies, which is also known as Travelers and is an American insurance company. It is the second largest writer of U.S. commercial property, casualty insurance, and the sixth largest writer of U.S. personal insurance through independent agencies. As for Travelers, their revenue growth is consistent across the years and is showing a positive growth year after year. Whereas for the net income growth, particularly for the trailing 12 months, they have been suffering a bit and is currently showing a negative 8.45%. Looking at their valuation, they're also priced higher than the sector median for the most part, except for their price to cash flow for the trailing 12 months and their forward price to earnings ratio. Their balance sheet looks healthy and their total assets well exceed their total liabilities. Lastly, we have Walgreen, which is an American holding company headquartered in Chicago that owns Walgreens, Boots, and a number of pharmaceutical manufacturing, wholesale, and distribution companies. As for Walgreens, their revenue growth has been consistently growing year over year, but their net income growth has been struggling. In fact, their December 2019 shows a negative 20.74% compared to the year before, and their trailing 12 months is also showing a negative 31.93%. Their balance sheet raises a couple of red flags for me. What I notice is that their total current assets is lower than their total current liabilities. As for valuation though, they are doing well better than the sector median. Alright, so now that we have reviewed all these 5 shortlisted companies from the Dow Jones, I'm going to share with you my pick. If I were to pick one of these companies, I would probably lean towards Merck. It is a pharmaceutical company. They are paying a very good dividend yield of 3.06%. Their payout ratio is very healthy. Their dividend growth streak has been also 9 years. On top of that, although their year-to-date performance has been negative 12.24%, they've had the best performance compared to the rest of the group of the 5 shortlisted companies that we reviewed so far. Also, as we looked at the valuation and as we looked at the income statement and balance sheet, Merck did better for me in terms of my analysis and what I'm expecting from a company of that caliber. That being said, I do encourage you to do your own research. Just because Merck was doing better in this video when compared to the rest of the Dow Jones stock, I think it always deserves itself to do a better comparison to other pharmaceutical companies that are within the same sector, because that allows you to really choose the best of the best in the pharmaceutical companies, even though some of them may not be actually in the Dow Jones Index. That's totally fine. For that, I do encourage you to check out the other video that we recently posted on our channel, Best Pharmaceutical Stocks to Buy for Dividend Stock Investing. We've also recently made another video where we talk about the banking stocks to buy and comparing the top banks in US, Canada, and Australia, which might be of your interest. I would love to hear from you. Let me know which one of these companies on the Dow Jones Index would you consider to buy. Do you own any of these stocks? I hope you enjoyed this video. If you did, please hit the like button and subscribe to our channel. Here on Momentum channel, we post weekly videos about stock market investing, finances, and personal development. Hope to see you next time.